I am still reiterating, we bottomed July 15th. One of the reasons why we did is because of our first guest. Hey, we got a star-studded show to... Always wanted to say that. Always hear the other guy say it. I always wanted to do it myself. It's just a cliche. It doesn't make me feel any better about it. Anyway, okay. During this daytime show, we had a company that reported a monster good quarter, helping to turn the bank stocks around, which in turn then helped, by a peak in oil, put a bottom in most of the stocks I follow. That's why I'm thrilled to welcome the one bank guy that seems to have anything positive to say. It's John Stumpf, Wells Fargo President and CEO. Welcome back to the show, John. Good to see you.
Thanks, Jim. Thanks for having me on.
Okay. You did something when everyone else is, when many of the players, notice how I got rid of the absolute because I am not given to hyperbole. When many of the players in your sector were cutting dividends, trying to find some explanation about how they could eliminate their dividend, you raised the dividend. And yet there's a lot of analysts who said, well, that was just for show. Do you ever raise the dividend for show?
Well, of course not. You know, we never overpaid a dividend in past years. We're not going to do it right now. We have the earnings, we have the growth in our balance sheet and in revenue, and we've always paid out 40 to 50% payout ratio on our dividend. And if you normalize the last 3-4 quarters when we've actually been building loan loss reserve, you take the real earnings, it easily supports that kind of dividend.
John, I'm an old guy. I may actually be older than you. Candidly.
Well, then you are old.
Okay. I pretend to be 63 because it's better to be a younger-looking 63 than an older 53. In 1990, when everyone was shorting the bank stocks and people were shorting you left and right, suddenly a new buyer emerged, Warren Buffett. Your numbers shown. Are we perhaps experiencing the same thing? Perhaps a bottom like we had in 1990, and who's leading us out again? Wells Fargo.
Well, I don't know that necessarily we're leading it out, but I will say this. Surely there's stress in the industry right now, stress on the consumer side, but because of our capital strength, because of our liquidity, and because of our operating model and our values, we're actually growing today. There's actually less competition. People are, inwardly focused, trying to fix our balance sheets. We're out trying to grow ours. So these are not necessarily bad times for us. We tend to outperform when times get tough.
If Fannie and Freddie were to be confiscated by the U.S. government, as Barron's pretty much said this weekend, would that be good or bad for the business of Wells Fargo?
Well, I don't know exactly what a confiscation means, even if it's going to happen. The GSEs, Fannie and Freddie, are important for housing, and housing is important for the United States, and the U.S. is important for our market, for our business, because that's where we do business. So either, in terms of housing, there has to be some mechanism to help get debt, the $11 trillion of mortgage debt in this country, into the secondary market. So they're important for that perspective.
You don't think that
But in the short run, we're going to do just fine, whether Fannie and Freddie are in their way or not. I mean,
okay.
It doesn't make that big a difference.
When I talk to people who are still negative about Wells Fargo, one of the things they pointed out is maybe it was not correct to raise the dividend, given the fact that all of your portfolios are showing deterioration. And while the firm may argue that there is still great growth to come, the actual loan defaults are not peaking yet, are they?
Well, let's take a look at the dividend. So we increased from 31 cents a quarter to 34 cents. So it's another $400 million of dividend payout annually. I mean, this is a company that last year made $8 billion, give or take. So it's not like, this is going to be the end of the world. Clearly, we are seeing continued pressure on the loan portfolio and so forth. But as you well know, things will bottom out. The quicker we get to the bottom, the better. And we're bullish on this country.
Excellent. After the break, we're going to have John Stumpf stay with us because he is the most important man of the hour, I believe. John Stumpf, Wells Fargo President and CEO on Mad Money at the Half. Thank you for sticking around.
Coming up on Mad Money at the Half. Credit crisis flashback? Bank's in trouble again. Kramer's got more with Wells Fargo CEO John Stumpf to give you the truth about the future of the financials. Plus, Kramer takes the pulse of the prosperous with Lowe's Hotel CEO Jonathan Tisch. Tick-by-tick analysis from the man with his finger on the pulse of the market. Get more Kramer on on Mad Money at the Half.
Regular viewers of the regular Mad Money know that we've been saying that Wells Fargo is one of the Fortress Four, one of the banks that is actually worth investing in a sector that we cannot stand, which is why we're thrilled to be live with John Stumpf, Wells Fargo President and CEO. John, one of the things I like to do is challenge my own thesis when I like a stock, because I never want to get too bullish. These are just pieces of paper. So I'm going to the work of Meredith Whitney, who has a sell on Wells Fargo. She's noting that you changed the way you report for home equity loans, and it created an aura of what she believes could be an too positive a way of looking at all your home equity loans, and that if you had not changed the way you report, you would have had a dramatic increase in bad home equity loans. Why did you change the policy, and was it to make things look rosier the way Meredith Whitney implies?
Well, it surely was not to make it look rosier. We changed our charge-off policy from charging off home equity loans from 120 days to 180 days. Incidentally, the industry is at 180. And by giving us 180 days before we charge a loan off, we had more time to work with our customers. So it was actually a customer advocacy, not anything about the income statement. And what happened is we charged off, we had $268 million or so of charge-offs that would have happened in the second quarter that did not. But here's the magic, or here's the answer. We took a $3 billion charge in the second quarter for bad loans. $1.5 billion of it went for the charge-offs and $1.5 billion to build our reserves. So it was in no way to any way impact or minimize or some way overstate the earnings of the second quarter. Just the opposite.
Okay, another critic.
And it was customer-driven.
Okay, another critic of yours, my old friend Peter Evis, Wall Street Journal, mentions your CDO exposure. When you were on earlier with me, we actually jested that you didn't have any of the fancy Wall Street stuff, the CDO, the SIV. Now we're reading about level 3 exposure, which means illiquid securities, and that you have indeed a lot of CDOs. How do we explain the discrepancy between what we thought was not the kind of Wall Streetization of crazy securities that Wells had stayed and was immune from, and the fact that level 3 securities are up big and you've got a huge amount of CDOs?
Well, we could spend a whole program talking about the whole fair value accounting, FASB 157, but let's talk about level 3.
Okay.
These are assets that there's no observable prices in active markets. And we increased those from $21 billion a year ago to $33 billion this year. Half of the increase came from some auto loans that are in security form. The other half were from mortgages that came out of level 2. Level 2 is where you can price things, where it's observable prices in markets where you have like assets. Some of those things were mortgages. There were no mortgage market anymore, secondary market for jumbos, so we put them in level 3. We had to. And we fairly valued them, and we took significant write-downs in those assets before we moved into level 3. As far as the CIVs and CLOs and CDOs and so forth, we have no CIVs. I mean, when I heard that, I thought it was a four-wheel drive. I mean, I didn't know what that thing was.
But do you have less than $1 billion in CDOs? Do you have less than $1 billion in CDOs, sir?
You know, our last, I think it was either our 10K or the Q talked about $860 million. $860 million is
the current public.
And that was our last reporting on those. So the fact of the matter is a $610 billion company has 5.5% of its assets in level 3, and most of that is either auto receivables or mortgage servicing rights.
Right.
And just these are very small numbers in the overall scheme of things. So, we didn't miss every bad party, but we missed most of them.
One last question. You do not have core deposit growth, and yet you're growing your balance sheet. Is that not dangerous and not the Wells way? Usually you do your growth through core deposits. You're not using them right now to grow.
Well, a year ago, or a year and a half ago, our balance sheet was about $125 billion smaller than it was today. It was undersized, Jim, because we couldn't find good assets in which to invest. So we shrunk, frankly, the balance sheet. Today we're seeing good spreads. We're finally seeing, risk being priced into the return, and we've been growing the balance sheet and we've grown liquid assets, and we use some short-term debt to do that. It's not outsized by any stretch of the imagination. In fact, more of our assets are funded in core deposits than almost any one of the big banks. So this was smart business, not any, a different way of doing business.
John Stumpf, thank you for telling it the way it is. I think you've answered the bears. You are why I think you're the best bank in America. Thank you for joining us, John Stumpf, CEO, President of Wells Fargo. Good man. These are tough questions. He answered them all. He didn't duck Whitney. He didn't duck Evis. He gave us the answers. You be the judge. I think this one's inexpensive, even though it's twice book. Mad Money at the Half. We'll be right back.